Actually, investors are stashing nearly $6 trillion in money market funds as high interest rates gave those instruments better returns in the stock market. But if borrowing costs fall in 2024, will that hoard of cash make its way back into equities and push the markets higher? Our next guest says history could be telling otherwise. Let's bring in Adam Turnquist, Chief Technical Strategist at LPL Financial. Adam, great to have you with us. You actually wrote about this in August. I thought this was really interesting, the chart, because you find that it's not now. People aren't going to be cycling back into equities right now.
That's the message history has told us. When you look at the previous 4 major peaks in money market assets, they really did not start to roll over until we were well into the rate cutting cycle. I'm still getting used to saying rate cuts after the last year here, but that's really been the trend in history. And I don't see any slowdown. If you look just at November fund flows into money market assets, you had $200 billion going into money market assets despite rates coming down. So that trend is still up for now. I do think that you'll have some flows coming into equity markets, of course, and support the market, especially a lot of offsides positioning. There's confidence in this market as well. And I think we've seen the highs for interest rates. So supportive for the market, but I don't think it's worth holding your breath for an imminent trend change here with fund flows into money markets.
But Adam, and I agree with you. I see it with my clients. I think you also, though, have a dynamic. How do folks feeling about having? Do they feel like they've missed a move in the markets? And if you think about the intensity of where and how quick the velocity of the move higher, which got a lot of people off the sidelines. And as Courtney referenced too, it's great to earn 3 to 5% in the front end of the Treasury curve, but at some point equities outperform over time. And so when you see this kind of a move in markets, it's hard to feel great here if in fact you've been cashed up.
Yeah, and the other opportunity cost is not locking in some of these yields right now that you're seeing in the market. So if you're missing on both ends, if you're missing that equity market rally and some of this rally that we've seen in treasuries, we think, and we've been telling our investors and clients to really lock in some rates. You don't need to go far out on the curve. You don't need to take additional credit risk into high yield. Lock some of these rates in now. We think, again, that the upside in yields is likely capped as we look ahead to 2024.
Is there data, Adam, on where that money actually goes when it goes from a money market or treasury bonds? I mean, I'm sure not a lot of it goes straight into equities. Some of it must go elsewhere, like maybe corporate, some sort of intermediate step.
I think if you think about fund flows, fixed income is probably going to be first downstream coming out of money markets. If you think about the investors that are sitting in money markets, I think from a comfortable standpoint, I think, again, they're probably going to move into more of a fixed income, safer security versus chasing this equity market rally. In terms of data, we did see some pretty good evidence of fund flows coming back into U.S. equities just over the last week, of course, powering this rally that we've seen broaden out significantly over the last several weeks.
All right, Adam, we're going to leave it there. Thanks so much for joining us. Appreciate it.
Thanks.